Hey guys, we are back and we have an exciting show for you today. What's up with the interest rates? Today, joining us, we have the one and only Mack Dadyan from NFM Lending. Welcome, Mack.
Appreciate it, Robert. Happy to be here. Good afternoon, everyone. As Robert said, I am Mack Dadyan. I am from NFM Lending. We are a mortgage lender based out of Haddonfield, New Jersey. We service anywhere from conventional VA, FHA loans, start to finish.
Yeah.
I know, Robert,
Mack,
we have an agenda, a lot that we wanted to cover.
yes.
I'll let you have the floor. You tell me what direction you want us to head in.
Yeah, we got a lot. We got a lot to cover for you guys, so stay tuned. And this is one of a series of videos we're going to put out together because, look, most people aren't buying a house without getting a mortgage, right? And Mack's going to help us figure a lot of that out. So, but first, Mack Dadyan, who are you? How long you been in mortgages? And let's peel back a little bit of a layer of the onion here. Tell us a little bit about you.
Yeah, so I'm 34 years old. I born and raised pretty much in Cherry Hill. Went to Rutgers, graduated finance economics degree. Floated around like a lot of people do until I, met a guy at a wedding, said I should get in the mortgage business, and that's going on 9 years ago now. So it's been a successful venture. I started out as an assistant, and after about a year and a half, went on my own as a salesperson. And now fast forward to today, I have some support staff. You've had the pleasure of working with John and Nicole. And then I also have a sales guy, Larry Colangelo, as well, too, on my team. So, we've overall been in very good times since I've been in the business. And today things are a little different than when I started, and even the past couple of years. We're in a very different market. So, big topic, interest rates, right? And
Yeah.
where interest rates were, where they're going, where they're headed. I mean, there's so much we can cover, top to bottom. Where do we start, right?
Right. So today, guys, what we want to share is we want to dissect Mack's take on the current market as it pertains to what is he seeing on the mortgage side of things. Are people getting approved? Are they having trouble getting approved? Mack, do the student loans, did they play into this? Because as we record this, the student loan repayment has begun. Listen, like the finances have been on hold for over 3 years since COVID. It's like 3.5 years. So people haven't had to pay those. The interest rates were historically low, but in the last year, we've seen them rise. And guess what? The prices of homes are still going up. That's what's crazy. So we were chatting before we started recording this, Mack. So like, what are you seeing? Let's start with the concept of pre-qualifying for a mortgage. Mm-hmm. What are you seeing when you're looking at people's finances, and how does the interest rate, which right now is kind of flirting with 8% for a conventional loan, what are you seeing now compared to a year ago?
Sure. So very important thing you brought up was student loans, right? So when you're going through the pre-approval process, part of that process is that we're taking a look at all your debt versus what your income is, okay? So the big piece here about that is that with student loans, a lot of these loans during COVID were in some form of forbearance. And because of that, payments weren't hitting the account. So depending on what mortgage program we were going with, there was a limited payment that we had to count against the customer, or no payment at all. Where now, a lot of these credit reports that we're looking at, these payments are now on the credit report. And a lot of times it's a lot more than what that minimum basic payment that was required by either Fannie Mae or FHA for the qualifying. So now we're looking at introducing more debt, to the calculation of the debt to income ratio.
Time out, man. I have a question. So let's just say, for instance, I had a student loan payment of $500 prior to the pandemic, $500 a month. And then for 3.5 years, I didn't have to pay my student loan. Now that things are changing, if I understood you correctly, maybe I didn't, you'll tell me, did you say that now, if I go to apply for a mortgage, that what was my $500 payment might be a bigger number showing up on my credit report?
Well, more so what I meant by that is that a lot of these student loans weren't showing any payment whatsoever. So certain, like Freddie Mac, we take 0.5% of whatever your balance is, and that's the payment. Or Fannie Mae, 1% of the payment. Or FHA has another calculation.
Okay.
VA loans have another calculation. So back then, before things have caught up, we could just make that calculation and count it against you. Or if you had paperwork that you were fully in forbearance, or that you're in an income-based repayment plan and that payment is zero, that's what we could count. Now what's happened, or at least what I'm seeing on credit reports, is that now a lot of these student loans are being fully amortized. And in some cases, that payment that now is being reflected on the credit report is significantly higher than those calculations that we used to take. So in qualifying, that's in some cases, if you have 100,000 in student loans and your payment's $1,500, $1,800, that's pretty much a small mortgage in itself that we're counting against you. So we're seeing a lot of that right now. And another piece of that, if I can jump into it, is that's affecting people from qualifying is interest rates. So we have a future segment to dive more into it. But right now, if you look at the history of interest rates, we enjoyed during the pandemic some unprecedentedly low interest rates. I mean, we saw 30-year mortgages as low as 2.5%, 15-year mortgages at 1.992%. Where now today we're seeing the average interest rate across the board anywhere from 7.5% to 8% on a 30-year mortgage. Now, if I can share, Robert, this screen with you to just kind of put the numbers into perspective for people. So this right here, what you're looking at is a loan for $400,000 at 3%. You had a monthly payment of $1,686.
So
that's a principal.
So just let me punch that up a second for you. So literally, if we rewind the clock, right, a few years, and you were quoting a payment for someone, $400,000 house, is that what it was?
Yeah. So the loan amount's $400,000.
A loan. Okay. The loan amount was $400,000, not taxes. That we're not talking about down payment. You're actually borrowing $400,000. A few years ago, you'd be quoting a payment of $1,686 for a $400,000 loan. Remember that number, guys, $1,686.
$1,686. Now fast forward to today, where I'm starting to see the number 8 quite frequently. Now that $1,600, $1,686. Now the principal and interest is $1,935 or $2,935. I'm sorry.
So about $1,300 more. Year and a half, 2 years later, maybe.
Yeah.
$1,300 more for the same amount of money, and actually probably a little less house because the prices of homes have continued to rise.
Yeah, correct. So, that's an incredible increase. Before, when I have conversations with customers, it's, hey, how can we get the payment $100 less, $200 less? Now we're talking about a payment that, if they were shopping during the pandemic and still haven't found the right house, they started with a payment that was $1,300 less. That prices a ton of people out of the market, because generally when we're approving people, in a lot of cases, and today where a lot of us have a lot of consumer debt, we are pushing their qualification to the max. So if a program allows a 49% debt to income ratio, meaning 49% of your gross income can go towards paying your monthly debt obligations. Okay. If they were shopping for a $400,000 house at 3%, all things remaining equal, they are no longer shopping for a $400,000 house. They might have just lost almost $100,000 in purchasing power just because interest rates are now closer to 8%. So a lot of people are being priced out of their own market where they need to be. If they're looking in a town or a neighborhood where the homes are 400,000, and now to get that same comfortable payment, I have to only lend to them 300,000, they might not be buying a house.
Yeah, that's a really good point. We saw that happen a lot. I'm not seeing it as much right now, but there are some older clients, older meaning they've been in the pipeline longer, not because they're
Yeah.
older and have gray hair like me. They've been in the pipeline a while, and if they were shopping at, let's just say, use your example, say 400, $500,000 house. Let's say it's a $500,000 house. They were going to put down 100,000. If they didn't get that house a couple of years ago, where they took themselves out of the market for a while, as the interest rates have climbed, now the buying power, not only have the homes probably gone up 5 to 8% since then anyway, but yet their buying power is now down to another 100,000 lower, $150,000 lower, just using, conversational numbers. And that's tough, man. That's tough, because if you've seen the $500,000 house, you probably don't want the 350 house, right? Your
Well,
expectations change.
here's the thing too. It all sounds negative, but here's a positive spin on everything. A lot of times, those are rare cases for people that are maxed out at their budget.
True.
Majority of people, or a good portion of people we talk to, they were at 400. They're still at 400. It's just their payments more, and they're wrapping their head around that. But here's where I come in with a solution for that, and that's where we're pushing this concept of what's called a 2-1 buy down. A 2-1 buy down, where essentially it's a program, a conventional loan or an FHA loan structured in such a way that for the first year, your payment is based on an interest rate that's 2 points less than the current rate. And then your second year is based off an interest rate that's 1 point less. So back to this example, if you do a 2-1 buy down with us, your first year of payment is not based on an 8%, it's based on 6%. And then your second year's worth of payments is based off of 7% interest rate. Okay. And then year 3, it reverts back to the 8%. But if anyone is following economics and following rates, we're all pretty confident that within the next 2 years, at the bare minimum, rates are back down to 6%. There's even a good possibility they can be back down to the low 5s, maybe even high 4s. So the idea in this program is that it gets people into homes before they go back next year and home prices go up even higher. It gets them into the home around a payment that's comfortable. And then they just bank on the fact that they have an opportunity to refinance in the next 2 years before they actually even see that 8% interest.
Wow. Okay. There's a lot there. Wait a second. What about an ARM?
So there's something going on that's called margin compression. Okay.
Okay.
The way majority of banks, mortgage companies, the way we make all our money is that when this loan, we give the loan to the customer and they go to closing and it closes. In post-closing, that loan gets packaged and it gets sent to some form of governing body to securitize that loan. In some cases, that governing body is also purchasing the rights to that loan. In other cases, it's going to a different investor. And this is the secondary market. We could probably do a whole video on it because it gets a little complicated. But to keep it simple, we make our money when we get that loan securitized and sell off the rights to that loan. Okay. So for simple numbers, for conventional loans, most of the time they were giving us as the bank 2.5 percentage points. So on a $100,000 loan, we were getting a check for $2,500. Now that's just not the case. Okay. Now that $2,500 might be $1,700 or $1,800. And it's out of that $1,800. They pay me, they pay our team, they turn the lights on, they cover all the departments involved. So because of that, there's only a small number of products and rate combinations that get offered to the market at a decent price. And because of that, we're seeing that a lot of times adjustable rate mortgages right now aren't much better than a fixed rate. So where fixed rate might be at 8% on a 30-year, we might see the 30-year ARM or a 7-1 ARM, 6-1 ARM. We might see that only a 1/4 point less than 8%. And in my eyes, I wouldn't want to take that risk for a
Yeah.
quarter point savings over the course of a couple years.
Very interesting. So the 2-1 buy down, write that down. You guys are watching this, write that down. That 2-1 buy down is a really interesting option to kind of give you some interest rate relief for the next year or two with the speculation. And I totally agree with you, Mac, that within a couple of years, the interest rates will drop back down. But what I don't think will happen is I don't think the prices of homes are going to come down. I don't see that moving significantly. It's a very different set of ingredients in this market as compared to 2008, 2009. Very, very different. So the 2-1 buy down sounds like an awesome option. I'm glad you taught me about that. Yeah. So what are you seeing? So you see qualification, right? Not, a lot of people, it's more about the payment discomfort and just getting used to it and wrapping their heads around it. It's not necessarily that they don't qualify. In some cases it is, I'm sure, but in many cases it's just, okay, let me wrap my head around this. My payment's going to be X. And then in the future, when rates drop, I can always refinance, and you do refinances as well, right?
100%. Yep.
Yeah. So one of the indicators I know that we've talked about in the past that you guys look at on your team and trying to predict the future is you look at new mortgage applications, right? Because theoretically, a potential buyer will be putting in a mortgage application at the onset of a relationship with a real estate agent. And you know that could potentially turn into a closed sale in 1 to 3 months, something like that. So I know you track those numbers. What are you seeing on your team? What are you seeing in the industry?
Yeah. So, on more a micro level of myself and, my team, numbers are down, every single month, during the pandemic, I was getting, me personally, people were reaching out to me every single month in the amounts of anywhere from 175 to 200 people a month, looking for either a refinance or a purchase mortgage or a home equity line of credit. Then 2021, pretty much the same. Then 22, those numbers started to dial back, where maybe we were seeing 100 people a month. Now, fast forward to today, some months we might be lucky if 60 people are interested in a mortgage. And then out of that 60 people, we have to take applications and see who actually is qualified for it. So on the micro level, numbers are absolutely down, across the board for us. At a macro level, if I can share this with you, Robert, as well, too. So a good indicator, Fannie Mae, Freddie Mac, if anyone doesn't know what they are, they're pretty much the two largest purchasers in the secondary market of mortgages. So they have a pretty good idea what's going on in the market when they're buying, trillions of dollars worth of mortgages, every single year. But let me just share this real quick with you and present this. If we look at demand on a macro level here, I find this very interesting. Here we go. So this is off of Fannie Mae's website, and this is mortgage loan applications for purchase primarily, not even looking at refinances. And as we can see here, purchase mortgage applications, where we are at today, it's the lowest demand that we've had since 1995 right now.
And that's tracking like across the United States?
Correct.
They get numbers reported from lenders just like yourself?
Correct. Exactly. Because what happens, a majority of lenders, they use a system called Encompass that's Fannie Mae based. So that accounts for maybe, I would probably venture to say 70, 80% of the originations. So every time a loan gets registered in there, Fannie Mae knows that. So that's kind of how they track those numbers. So demand is down. But again, if I can add, I see this as a huge opportunity for a motivated buyer to come in and have less competition out there in the market and maybe potentially not have to go $50,000, $60,000, $70,000, $80,000 over asking, which you and I saw a lot during 2020 and 2021.
Yep. Waiving everything, waiving appraisal gaps, waiving inspections, like crazy stuff. We have some videos on our channel about that stuff. This is a really interesting chart. So lowest since 1995, interestingly, the high number, a lot of us would have thought it was, 21, late 20, 21, early 22, which were great historically. But look at the oh 04, oh 05, oh 06.
Mhm.
Holy cow. Wow. That's like off the charts kind of numbers. And I know it was little bit before you got into the industry, right? But that's crazy. That's some crazy
Yeah.
numbers there.
Oh, I have a few relationships with a few builders, and they all talk about that time period. Oh 04 to oh 06 was just, we it was after 9/11. We'd been in war for a couple years now, and there was just a boom after 3 years of settling in the Middle East. There was just a boom over here of building. I'd have to do more research to see what caused that, but that laid a lot of groundwork for a lot of the builders to be able to go out there and compile a almost like back not data, I'd say a backlog of lots to hold on to, develop, and be ready to build whenever the time was right again. So
So that's interesting. So you think, and obviously we don't want to digress too much, but you think that surge was driven a lot by new construction, not resales.
I think it was driven a lot by new construction, honestly.
Can I tell you what I think it was driven by?
Yeah, come on.
I think part of I was doing this then. I think
Yeah.
part of what was going on also back in those mid 2000s is the lending guidelines were a little different. And I kind of joke around that if you had a pulse, you could get a mortgage. If you made 50 grand a year, you could get a house for 500. And there were a lot of mistakes when they loosened up a lot of the regulations. And there were too many people that thought it would never slow down and they got themselves in over their head. There were a ton of arms, also a ton of
Yeah.
adjustable rate mortgages out there. And then when the rates adjusted, people got themselves into trouble. And then bang, there comes 2008, 2009 as this big melting pot of things that were going on. So there was a lot going on. It was a really interesting time.
Yeah, I think that the chart, if you take the chart from, you know, 2006, 2004, that level, I think, is a pretty good natural level. And then a steady incline would be more natural for, citizen growth in the US and homeowner growth. I
Yeah.
mean,
Yeah.
oh, the peak of the chart and the valley of the chart, one's too high, one's too low. So somewhere in the middle there, around the 300 range, is probably a good place to be.
Yeah. Mac, can you write loans in other states outside of New Jersey?
I can do so. The type of lender that I work for, I have to be licensed in each state I lend. So for me, that's uh, Delaware, Pennsylvania, New Jersey, and Florida. I'm licensed in.
All right.
So
Awesome. Well, I appreciate you sharing all this awesome information today, guys. If you want to get in touch with Mac or his team, I will make sure that all their contact information is in the description box below. If you'd like us to help you and partner up with Mac and his team, our teams work really well together. We'd love to help you get the home of your dreams. If not now, when? Right?
yeah,
So all our contact information will be down there too. As always, Mac, it is a pleasure to speak with you and learn from you.
awesome to be here, Robert. Appreciate your time.
All right. We'll see you guys again real soon.